Welcome to this explainer. We are jumping right into a story about a financial titan that completely rewired how everyday people build wealth. We're talking about Vanguard and the absolute explosion of index investing. This isn't just some dry story about a financial product. It's actually a story about what is arguably one of the greatest transfers of wealth back to the middle class in modern economic history. Today we're going to look at how a seemingly basic mathematical concept fundamentally disrupted Wall Street's most profitable business models and, quite literally, changed the mechanics of global investing forever.
Okay, let's dive into this. Imagine investing in hundreds of companies with a single purchase. Today, that concept is so ubiquitous we hardly even think about it. But to really grasp the magnitude of this disruption, we have to look back at what investing was actually like before this idea took hold. Imagine an era of steep commissions where just executing a trade meant calling a stockbroker on the phone and paying exorbitant fees just for the privilege of participating. The whole landscape was incredibly exclusive, opaque, and wildly expensive. You had to constantly stress over picking individual corporate winners, and you were heavily penalized by trading costs every single time you tried to react to the daily news cycle. To replace all of that friction with one single, highly diversified purchase, that was a radical proposition. It was a massive what-if scenario that ultimately propelled Vanguard to become one of the absolute largest asset managers on the planet.
Section 1. A Radical Investing Idea, Disrupting the Status Quo in 1975.
And this brilliantly illustrates where all that friction started, with the founding of Vanguard by John C. Bogle. See, when Bogle entered the scene back in 1975, the establishment was entirely dominated by active fund managers. The whole ecosystem of Wall Street was built on this premise that highly paid experts could actively analyze data, predict the winners, and consistently outperform the market average. It was an incredibly lucrative business model, built entirely on high management fees. Bogle, however, looked at the data and came up with a highly controversial, totally disruptive vision. He completely disagreed with the active approach. He argued that the high costs of active management were actually destroying investor returns. Instead of trying to beat the market, he proposed keeping investment costs as close to zero as possible and simply tracking the market average. Well, Wall Street elites actively laughed at this guy. They famously dubbed his first index fund Bogle's Folly and called it downright un-American to settle for being average. But they weren't just laughing because they disagreed. They were laughing because Bogle's vision was a direct existential threat to their fee-extracted business models.
Section 2. Tracking the market. Demystifying the index fund.
Let's define exactly what we're talking about. An index fund is a fund that aims to follow the performance of a market index rather than selecting individual stocks based on predictions. Now, for anyone who follows finance, that definition is pretty straightforward. But the actual mechanics of the disruption are where things get absolutely fascinating. John Bogle loved to say, "Don't look for the needle in a haystack, just buy the haystack." By aiming to just mirror the broader market, index investing leverages this profound mathematical elegance. Think about it. Investing is essentially a zero-sum game before costs. For every trade that beats the market, someone else must have taken the losing side of that exact same trade. But after you factor in the high costs, the trading fees, and the taxes generated by active managers, active investing becomes a guaranteed negative-sum game for the investor. So by simply owning the haystack, index investors guarantee themselves their fair share of the stock market's return. Meanwhile, active managers as a collective group are mathematically guaranteed to fall behind due to the compounding drag of their own fees.
Section 3. Vanguard's Unique Structure, the Mechanics of Mutual Ownership.
Now, what's really interesting about this slide is how it breaks down the structural moat Vanguard built. The philosophy of indexing is brilliant, for sure. But to truly understand Vanguard's absolute dominance, you have to look at how they operate internally. It completely flips the traditional corporate model on its head. Here's the sequence. Step 1. The investors themselves own the U.S. funds. Step 2. Those U.S. funds are actually what own the Vanguard company itself. And step 3, because of this, the mutual ownership structure inherently keeps costs relatively low. This isn't just some quirky corporate layout. This is basically Vanguard's killer app. Think about a traditional Wall Street firm for a second. They essentially have two masters, the investors in their funds and the public shareholders who own their corporate stock. Those external shareholders demand massive profit margins. Vanguard just completely eliminated that conflict of interest. Because they're owned by their funds, they operate essentially at cost. This makes it structurally impossible for traditional Wall Street competitors to truly copy Vanguard's model and compete on price, because doing so would require eliminating their own corporate profits.
Trillions. That is the result of this structural genius. Vanguard manages trillions of dollars for millions of investors globally.
To put that abstract, massive number into perspective, because of this insane scale, Vanguard is typically one of the top shareholders in almost every single major publicly traded company in the United States. This structure created an unstoppable virtuous cycle, a massive flywheel effect. Basically, the lower Vanguard dropped its fees, the more money flooded in from investors. That massive influx of capital created unprecedented economies of scale, which allowed Vanguard to drop its fees even further, which then attracted even more money. Today, these low-cost, highly diversified funds form the absolute bedrock of institutional portfolios, target-date retirement funds, and advanced wealth-building strategies all over the world.
Section 4. The long-term perspective. Risks, realities, and lasting impact.
Now, to keep things balanced and really synthesize the source material, we need to elevate our understanding of the realities involved here. Index investing has risks. Markets rise and fall, and investment values are not guaranteed. But for the advanced investor, it's really about understanding the specific type of risk you're taking on. When you buy an index fund, you are effectively eliminating idiosyncratic risk. That's the risk that a single CEO makes a terrible decision or a specific company, like Enron, goes bankrupt. But the trade-off for eliminating that individual company risk is that you fully absorb macroeconomic systemic risk. You completely surrender the ability to sidestep market crashes. If the S&P 500 drops 20% due to some global event, your portfolio drops exactly 20% right along with it. The index funds simply rise the wave of the broader market, which means you are entirely exposed to the absolute volatility of the global economy. So the crucial point is how you handle the ultimate behavioral challenge of this strategy. We can boil this down to 3 simple lessons of long-term investing. Stay disciplined, keep costs low, and give investments time to grow. Honestly, these concepts sound incredibly simple, don't they? But they are psychologically brutal to execute in practice. Staying disciplined is super easy when a bull market is roaring, but it requires immense mental fortitude when a recession hits, your portfolio drops 30%, and the financial media is practically screaming at you to panic and sell. Keeping costs low requires you to actively ignore the siren song of flashy new funds, boasting incredible, yet often totally unrepeatable one-year returns. And giving your investments time to grow? That means doing absolutely nothing for decades, completely defying our natural human bias toward action and intervention. Index investing isn't really a test of intelligence. It's a monumental test of psychological endurance.
We've explored the disruptive, mathematical genius of indexing. We've looked at the structural moat that keeps Wall Street at bay, and we've faced the unyielding realities of systemic risk. So knowing the mechanics, the structural brilliance, and the severe behavioral discipline required, how will you approach your own long-term wealth building? Thank you so much for joining me to explore this topic. Keep learning, stay curious, and I'll catch you in the next explainer.